If you've been trading for a while, or even if you just love lurking on trading forums, you've probably heard of technical analysis. In this video, I'm going to explain exactly what that means and how to get started. And I'll also be sharing some key tips for total beginners to technical analysis, so stick around if you're keen to give it a go. Just a heads up, this video is sponsored by IC Markets, so I'll be using examples from their MetaTrader 5 platform. It looks a bit like this, but there are other options out there. Remember, this is a brief overview and not financial advice. Okay, let's answer the important stuff first. What is it? How do you do it? And how does it actually work? In a nutshell, technical analysis is all about looking at past performance to predict future trends. It's that simple. It's done by using price charts most of the time. Traders will connect different price points with trend lines. Think of it like connect the dots, but for investors. Once you've connected the dots, the hope is that a clear pattern emerges showing how a stock's price moves over different time frames and under different conditions. That way you can figure out the best time to buy or sell. The big caveat here? Not everyone believes it works. Technical analysis is pretty hotly debated in the investment world, but it's been around for centuries and it's still used today, so it's worth taking the time to understand it at the very least. Okay, so let's get into the tips. Technical analysis always starts with a price chart. There are heaps of different types, but their goal is always to map out price trends. One of the most popular versions is the candlestick chart, because the bars look a bit like candlesticks. These bars show a stock's opening and closing prices, usually over a period of a day. There are times where you may also want to view price action on other time frames such as hourly candles or zoom out for weekly trading trends. Green stocks means a stock price went up, red means it went down. Sticking with the candle theme, the short lines are called wicks. They tell you the highest and lowest price ranges over the same period. Once you've gotten to grips with that, you can start looking at other indicators like trading volumes. Trading volumes tell you the number of buy or sell trades that are made for a stock over a given period of time. You'll find these at the bottom of the price chart in columns or lines most of the time. Trade volume matters because it can be an indicator of a prolonged trend or a possible reversal. So as a general rule, higher volumes tend to indicate a prolonged price trend, either upwards or downwards. Once you've got the hang of the prices and volumes, you may want to start looking at support and resistance. Just like any other product, demand for stocks is influenced by price. When a stock's price is low, more people want to buy it. And when a stock becomes too expensive, buyers will drop off and more people will sell. Analysts often add support and resistance trend lines to price charts so that they can predict these demand patterns. Support lines highlight the lower price range where buying typically starts to pick up. Resistance lines shows the higher price range where traders usually start selling. To find these support and resistance lines, traders often look to the moving average. That tells you the average price of a stock over a set period. That could be weeks or months or even years. You'll find the moving average on the price chart by looking for the letter MA followed by the number, say MA200 for example. This means the moving average shown on the chart is over a 200-day period. If a stock's price can't close above the moving average line, it indicates a resistance point. That's where more people are starting to sell than buy. If a stock's price can't close below the moving average, we find a support point, the level where more people are beginning to buy than to sell. Once you map out your support and resistance lines, trend indicators also start to appear. When stock prices fall outside of these lines, it could be a sign that a new trend is starting, like a bull market or a correction. Remember, the whole point of technical analysis is to figure out whether a stock's price is trending upwards, downwards, or sideways. At a basic level, a downward sloping line shows there are more sellers than buyers and that the trend might go on for a while. Some traders will take this as a sign to sell before prices dip further. But on the other hand, an upward sloping trend line means the opposite, and you might want to consider holding onto your stock for a longer period. We're not done yet though. Another popular indicator that lots of investors use is the relative strength index, which can help you figure out whether a stock is overbought or oversold. It's typically shown as a line graph like this, and might sit just below the price chart. RSI is measured over a 14-day period on a scale of 0 to 100, with 0 being the most undersold value and 100 being the most overbought. It's calculated using the asset's average gains and losses, usually over a 14-day period. As a general rule, the 70 mark is where a stock or asset is considered to be overbought, while 30 is the level where it's thought to be undersold. Finally, you've probably figured this out already, but just remember that human behavior is one of the biggest factors at play when it comes to technical analysis. Most of the time, people respond to certain events in the same way, which is why so many investors put their trust in technical analysis. But people can be irrational and weird things can happen that nobody could have predicted, even with the best analysis in the world. I also just want to add that this is a very brief overview. Some investors use all of these indicators and many, many more. Getting the hang of technical analysis is a long journey and there's so much to learn, but we'll be adding more videos like this to help you along. So give us a like and subscribe if you want to learn more.